live stream here over on Pepperstone's YouTube channel. Today, we'll be talking about everything to do with scalping, the stochastic oscillator, something that we had probably first started with when it came to trading and something we've never forgotten since that point. My name's Thomas Atkinson. As always, I'm joined by Tyron Abella. How are you going today, Ty?
Good, thanks, Tom, and yeah, welcome everybody. Yeah, stochastics is one of the first ones that you learn, isn't it? When we first started out, it was all over YouTube. It was the one. It in MACD were the only things you needed to know about trading to make millions and millions of dollars in the market. And and if you followed their versions, you would have lost it very, very quickly. But what we did certainly learn about stochastic is that used in the right environment and understanding what it is, it can be a very powerful tool to help you along the way. So most definitely a good indicator.
So today we'll be covering how we gain a little bit of a better understanding of how to utilize the stochastic indicator, how it can help us for scalping, day trading, etc. We'll look at some options in the market in terms of, checking it out and seeing how it might work later on. We use an indicator, so stick around for that. And of course, by the end of the session, we'll be able to have a look at how to interpret the oscillator's signals. We'll also be looking at learning some practical insights into integrating the stochastic with some other tools as well. And as always, we always encourage, if you have questions, please feel free to message throughout this chat room if you're watching this live, or put the comments down below. We do read them. And of course, let us know whether you're enjoying all the content. All right, let's see you on the other side. We've got a quick disclaimer just coming up. So the question always comes up, when do we want to use the stochastic indicator and how is it actually used? Well, today, let's talk about 2 essential tips for trading success when using the stochastic indicator. What type of market conditions should we be using it with? What are the 2 simple methods and concepts that we can use? And of course, what is our favorite time to use the stochastic indicator? Well, first up, I think, Tyron, we need to talk about how markets actually create a position. Now, stochastic indicators are often known to be used in a range-bound market. So how do we utilize the idea of a range-bound market? Well, we need to understand how a market actually forms a position. Often we talk about positioning from the big Wall Street players. What will happen is a market might come down or go up into a situation, and it will start to make a low, and then it will come back up to a high, and it might go back down to the similar low, and then it comes back to another high. This is what we call a ranging market, or some people will call it a channeling market. And the key to understanding that this is how markets build a position before going to the next location is that this is a time that many traders stop trading. They don't realize that this is a range-bound market, and this provides opportunity, especially for people that are using things such as oscillators, such as the stochastic indicator. So if we think about Wyckoff's theory, really, Wyckoff was contemplating that markets build a position over time. This is kind of a way that they build positions, and they cause what we call accumulation zones or distribution zones. Now, these accumulation and distribution zones end up forming what we call the channeling market. And the good little tip that we can remember today, one of our first tips here, is the 1-1-2-2 method. Now, we've mentioned this before, Ty, but the 1-1-2-2 method is basically 1 touch to both sides, 2 touches to both sides. And when we see this, it's time for us to consider using the stochastic indicator in the ways that we're about to talk about, isn't it? It's very important that we analyze markets this way.
Most definitely. Look, the one thing about the stochastic indicator, and sometimes the name and the description can be a little bit confusing because actually, in its essence, it is a momentum indicator. The stochastic is a momentum indicator. It's comparing the closing price of a trading instrument to the high and low range over a defined number of periods. So that defined number of periods is generally 14. So you're going to find in your platform most of the time the default is number 14. So 14 periods. So that could be a daily. If you're on a daily chart, it's 14 days. If you're on an hourly chart, it's 14 hours. But the name momentum doesn't really, a lot of people would say, okay, it's a momentum indicator. So what we're looking for is using it in a market that's actually moving, but it's actually not the case. We are looking for sideways moving markets and markets that are flatlining and in a distribution or an accumulation phase to actually use it to its best efforts. So, I mean, these are the calculations for it. You can see them on the screen. The good thing about technology, Tom, is that we don't have to actually manually work these indicators out. They're just there on the screen and they do manually adjust. So although it's good to know exactly what forms it, the most important thing to know is what it's actually doing. And it's comparing its price, its recent price of close to the last 14 periods as high and low. So what that's effectively doing, it's really isolating areas over that period, over 14 periods, where the market is either overbought or oversold in a sideways moving market, and that's where your advantage comes in.
Yeah, so our advantage comes from the idea of understanding that we are in a sideways market. Then we've got overbought and oversold conditions in that market, and we can use simple methods. And this is the second of the tips today in terms of understanding how we can apply this to our day trading and scalping strategies. So, Ty, do you want to walk us through two of these simple methods and how we might be able to implement it better when it comes to sidewaysing markets? Let's assume that this is, by the way, inside of an overall what we believe range-bound market is.
Yep. Remember that the stochastic indicator is always going to be at its most potent when you are in a sideways market. So identifying the market that you're in is extraordinarily important. And look, the most simple method of actually trading it is having your overbought and oversold lines drawn, as we can see here. Okay, so you've got to remember it's an oscillator. So the stochastic oscillator is effectively moving between a range of 0 and 100. Okay, so that's what's effectively making up. It can't go over 100, it can't go below 0, unlike other indicators. So just bear that in mind when you are drawing up your lines. The 80 and the 20 is what is considered overbought and oversold levels. So in its most simple form, what you're looking for is periods where the two stochastic lines are above the overbought line here, as you can see here in the first example, above the 80, and also below the 20 for oversolds. Okay, so that's where the advantage comes in. So we're obviously trading a sideways market, but we're trying to be able to scalp inside that sideways market. So we're looking at basically buying from the bottoms of the market that's moving sideways and trading up to the top, and then potentially reversing your position. That's where the stochastic is at its most potent. So the most simple method is actually just selling when it's overbought and buying when it's oversold. But we must reiterate that this only works well in a sideways market, because what happens in a market that is actually moving aggressively in a direction is that it will go overbought and it will stay there for a very long time because it's not getting the correct readings to actually reverse. So this works very well. And in a simple form, you could say, well, I'm just going to buy it when it's oversold and sell it when it's overbought. But if you don't recognize the right market condition and it does start to trend on you, then you are going to find yourself in an overbought zone fighting a very, very strong trend. No one wants to do that, Tom.
No, the 1122 definitely keeps you out of a bit more of a trouble there. Now, the second method is obviously seeing the crossover of these lines, isn't it, Ty? So what's that all about when it comes to crossing over?
Yep. So the crossover method is actually when the two stochastic lines actually cross each other in the overbought and oversold zones. Now, traditionally speaking, a lot of the time, if you're doing the normal literature, you would actually trade the cross no matter where it was, whether it was overbought or oversold. But our general way of looking at the market is you want to be only doing it when the crosses actually happen in an overbought and oversold zone. So you can see these vertical lines here. These red vertical lines are showing and indicating the crosses that actually happen inside the 80 and the 100 zone. You can see here the blue and red lines are actually crossing actually inside the overbought zone. So not below. The simple method only requires it to go into that zone and then come out of it again. The crossover method, which is obviously a little bit more information. So you're giving the market a little bit more room to be, compare itself to actually what's actually really happening in the market. You're giving it a lot more of detail versus the just go overboard or oversold and actually just jump in. You're waiting for confirmation here with a cross, but the cross in our way needs to happen inside the 80 zone, as you can see here with these examples. Now, the green vertical lines that we can see on the screen show the oversold versions of it. So again, you can see that each time there's a green vertical line, the two lines of the stochastic, the blue and the red, have actually crossed over each other in that oversold and overbought zone. So the green represents the oversold and the red lines overbought. So they're the ones that are giving us the clues. And as you can see, in each of these examples, in a market that is relatively sideways, obviously we've got to imagine that the overall market is sideways. And it doesn't matter, again, whether this is a 15-minute chart or a daily chart, they do actually change. The indicator does adjust itself accordingly. And as you can see, each of these signals has given us a reasonable movement out of that zone. So you can see that nearly all of them have actually had the market react in the direction that you would want it to after that cross. And this is why it's so powerful. And a lot of the time people say, Tom, the stochastic works great until it doesn't. But
Mhm.
when it doesn't, it's only identifying when the market's no longer in a sideways moving trend. When it does actually break out up or down, the stochastic completely breaks down. So that you really need to understand your markets to use it to its full benefit.
Yeah, cannot stress how important it is to recognize that 1122 method on it as well. So, Ty, what about stochastics? What time of day should we potentially use these? Now, a lot of people as day traders and scalpers, they might say very good. Maybe I see 1122, but by the time I'm using the stochastic, it's not working. It breaks out. It's London open. Volatility is increasing. All of these problems. Well, there are actually some periods of time where we see lower volatility, and that tends to bring in a range bound market. Now, that all comes down to timing, doesn't it? And what times do we usually see this happen?
Yeah, well, we're certainly not looking at the London Open because that's one of the most volatile times of the day. What we're really
Mm.
looking for is actually out of session times where, and there is a lot of those, or yeah, sometimes the quieter Asian sessions are very good, depending on
Mhm.
what you're trading, what instrument you're trading, of course. But generally, the London and also the London US crossover, when we have the overlap between the US and the London sessions, they can be very volatile times. That's not the ideal time to be trading a sideways market. It stands to reason that for the most part, sideways markets equal lower volatility, right? So what we're looking for is markets during the day that are less likely to break out, because we don't want to be trading a stochastic oscillator at a breakout, of course. So realistically, the Asian session for a lot of the instruments and the out of session. So before London Open, and if you're really, really keen after the US session closes, that's a very quiet time, sometimes a little bit too quiet, very low liquidity. But those sorts of indicators do work very, very well at those times because of that lack of liquidity, and the sideways moving markets actually do play a very important role in those times.
So I think the stochastic indicator is often misunderstood. Sometimes we think about it as just in sideways markets, just in range bound markets, but actually it can be used as a pretty good weapon when riding trends and waves to success. So, Ty, can we use stochastic indicators in trend? Well, the answer is yes, and we'll take a look at both bearish and bullish trend techniques, and more importantly, how we can potentially bring these indicators together with other concepts. So can we somehow build a confluence story? Like anything, if you've first heard about stochastic and you think, oh, that's a good indicator, I'm going to use that, it may work, but you might have to be using it with some other techniques as well. It's about building that confluence story. So first up, whenever you're thinking about, okay, well, I want to trade, let's say anything with a trend, how do we define a trend? How do we consider whether we're in a long trend, a bullish trend, or a short trend, whether it's a currency, a commodity, or of course a stock? Well, the answer is quite simple. We look to the price action. And more importantly, we think about the action of the markets from the perspective of, okay, can we see a upward trend or a downward trend? Now, how do we define a trend? Generally, it's a series of troughs and peaks. And if those troughs and peaks are continuing to go higher, that is, we have a trough, a peak, a higher trough, a higher peak, a higher trough, a higher peak, we are in an upward trend until the very end, aren't we, Ty? And the very end generally is basically looked at as when we take out that previous trough. So when we take that level out, we've broken the trend. And at that point, we might want to say, okay, we stop using the stochastic in the bullish form. And we might want to start thinking, okay, maybe we're going to use it in the bearish form. Over here, you have peaks and troughs. On the way down, peaks, troughs, lower peaks, lower troughs, lower peaks, lower troughs. That's effectively a downward trend. When does that end? Well, it ends once we take out the last peak. And when that occurs, we're looking potentially at taking out our bearish stochastic indicator and saying, okay, we go back to a neutral or maybe even a bullish side at this point. So identifying trends is important, Ty, but what about using stochastics in downward trends? How could we potentially do that?
Yes. Now, people who are avid stochastic supporters really want to use it every single time there's a trade. So what we need to do is actually work out where it's most beneficial. Now, again, we never want to be trading it against the current trend. The very, very important thing is if we are trading and understanding the market moving down or the market moving up. In this case, we've got a downtrend happening. What we're looking at doing is actually trading it in the direction of that trend. Now, by doing that, we're trading the pullbacks into the overbought, okay, and actually continuing the trend down. So We identify that we're in a downtrend. We know that we've got a series of lower highs and lower lows in terms of price action. And the most important thing that you'll find is we need to bring the level down of the overbought level. Traditionally, when we're looking at a sideways market and we've got the stochastic on in its standard format, we've got the overbought at the 80 level and the oversold at the 20 level. But when we are using it in a trend direction, we want to bring that level down. And the reason for that is because when the market is trending aggressively, sometimes the stochastic very rarely goes into the overbought zone. Now, it's very, very important to understand that if we're trading in a downtrend, the oversold zone, as you can see, it's not even marked on the chart here that we've got. It's completely off the chart because it is completely ignored. Okay, so it's very, very important to understand the market that you're in. And that goes for every indicator, by the way. It's not just the stochastic indicator. Moving averages are relatively useless in a sideways market, but in a trend environment, they're awesome. So a lot of understanding the market's movements is applying the right indicator for it. In an uptrend, well, we can go to the uptrend slide now. We're effectively doing the same thing. When we understand that we are in an uptrend, we know we've got a series of higher highs and higher lows out in price. All we do is relabel the chart again. So we look at the stochastic oscillator and we say, all right, we're going to, rather than having it at a 20, we move it up to the 30. So now the 30 is considered an oversold zone, okay? And again, the reason for that is you're going to get a lot more trades in, because when the market is trending, it's very rare that it's going to go against you on a stochastic level very, very deep into the 80. So you're not going to get a lot of trades. So once again, we move the 30 as our marker, and 30 to 0 is our oversold zone. Okay, so then we're looking at potential opportunities to trend in the direction. So we're always trading in the direction of the trend. As you can see, again, in this example, the overbought level is not even marked on the chart. We do not want to know about it. We don't even label it, because if we just completely ignore all of those crosses. But in the direction of the trend, the stochastic can give us some awesome entry points because they are relative pullbacks, and like I said earlier, it is a momentum indicator, and this is its truest form, giving you a momentum shift in an oversold zone to join the existing uptrend.
So basically, using stochastic and upward and uptrends and downtrends is possible. We just have to ignore one of the sides, and I think that's a thing that a lot of people do not consider. But how do we bring it together with another well-known technique? Well, one of the concepts that we always like is, of course, role reversal, where resistance, or a key point in the past, becomes potentially support. What if we knew we were in a series of higher peaks and higher troughs, and higher peaks and higher troughs? As it comes back down to the previous level of resistance, and then it becomes support, at the same time, the stochastic oscillator goes into the oversold area. And then it starts to cross. Now we use the cross technique, and it starts to cross to the upside. We could say, oh, there's another reason that supports our argument that this is a role reversal zone. Is that a powerful technique, Ty, that a lot of people don't utilize enough, having many levels of confluence when coming to trading?
Absolutely, it is. And understanding that and being able to apply the right instrument for the job is vitally important. So, yeah, stochastic is awesome when you're using it in that way, because it's giving you a clue, Tom, into the momentum shift nice and early. And that is going to be backed up by 3 or 4 other different things. So a lot of people completely ignore stochastic in a trend. And if you choose to do that, that's okay. But it does give you a very valuable insight of when the recent action is actually in an oversold zone, because it does give you a momentum push out of an area that is being confirmed by 4 or 5 other different things. It's like a little turbo boost button.
Yeah, that's exactly right. It's a little extra turbo. And we need the hit sometimes in these markets so we can get this. And it doesn't matter what time frame it is either, does it, Ty? If we're trading a 5-minute, a 3-minute, a 1 hour, a 2 hour, it's a great basic concept we can implement onto our charts and say, look, if it's there, it's there. If it isn't there, oh, well, maybe I don't need it. But what if I have 7 different reasons and I find, let's say, 4 of those reasons, and then can I have a more powerful strategy? Well, the answer is quite simply, yes, it could be more powerful. And therefore, that's something that we want to be implementing. So today we've taken a look at one important thing. Can we use stochastic and trend? The simple answer is yes, we can. We can use it in both bullish and bearish downtrends. It's usually best to use it with a confluence technique, such as role reversals, supply, demand, and other reasons, but it can be used. And I think that's very important there to understand that an indicator often considered as just range bound is possibly a trend indicator as well. So can we supercharge? So the question becomes, Ty, can we supercharge our trades? Can we use and unlock the power of stochastic indicators with something else? Can we use divergence and stochastic indicators to potentially unlock a hidden power? Well, the answer is, again, quite simply, yes, we can. And it's all about which divergence is the strongest. So today we'll take a look at which divergence is the strongest, how we use it on the charts, and of course, some examples of this divergence in action. What does it look like when we apply it to a currency, and how do we really apply it to these charts? So first up, we have to understand the types of divergence that we could be playing with and what divergence even is. Tyron, do you want to go through the different types of divergence and what we're seeing on this chart and which one, you know, you're kind of looking at in a little bit more detail compared to the other? Because there is a bit of a trap one here, isn't there?
Yeah, there can be some trap ones, yes. Now, divergence is essentially, and it can be used among different indicators, of course, right? So you can have MACD divergence, you can have RSI divergence, there's all sorts of divergence. So it's interchangeable in the sense of what indicator you're using. But in the stochastic version, what we're effectively looking for is a discrepancy between what price action is actually doing and what the indicator is doing. So you can see here in the Class C bearish divergence example on the left of the screen, we've got that green dotted line on price showing that price made a higher high than the previous high, and the stochastic indicator made an equal high. So you can see that although price made a higher high, the stochastic actually made an equal high. We call that Class C divergence. Okay, now Class A divergence, which is what we're finding in the middle here, is when price actually makes a lower low. You can see right in the middle of the screen, price has made a lower low, and the indicator has actually made a higher low. So it's completely doing the opposite of what price is actually doing. Now, remember, in a perfect balanced market, if price makes an equal high, the indicator would be expected to make an equal high as well. So that's where the divergence comes in. So in a flat standard market, indicator makes a new high, price makes a new high, price makes a new low, indicator makes a new low. What we're isolating here is examples where that doesn't happen. Now you can see again here, there's another series of Class A bearish divergence this time where the price made a higher high, as you can see, and the indicator made a lower high. And what's really important there, Tom, I think, is the reaction of what actually happened after that. So once you've identified that divergence, look at the explosive move out of that Class A bullish divergence and bearish divergence in the last example there, and how fast price moved away from it. So it's a very, very important concept, divergence, and it can be used in a few different ways. But what we generally find is that the Class A divergence is generally best for stochastic. Now, there are cases to be made for Class B divergence as well when we're using things like MACD, especially around double tops and chart patterns. But in the stochastic version, we find that the Class A divergence is generally the best one to look for because it seems to be the most effective, and we seem to get the sharpest price movements from it.
You gave away one of the tips before we even finished, Ty. That's all right, though. We do love Class A divergence. It usually is the best for these particular indicators, and that's why it's so aggressive with the move. And as I just put in there, Ty, we could use it together with some other techniques. Here we have just basic resistance. We have Class A bearish divergence. At the same time, we have this aggressive candle that comes in here. After we see the crosses to the downside, we could say, okay, well, maybe it's time for us to scalp. Again, building the confluence story whenever you're trying to do trades is very, very important. What you'll notice is that usually these Class A bullish and bearish divergences happen in overbought and oversold areas. And this is something we are looking for. We're usually looking for one to be like oversold in this case. And even if the other one is coming out of the oversold, and let's say it's at like a 30 or even a 40 at that point, what's that telling us about the indicator as well, Ty? The fact that it's already so high up and not even...
Well, it's telling us the momentum has already shifted and it's moving very quickly. So it's giving us an even more of a turbo boost. But as a general rule, what you want to be looking out for in that example that we just saw there was that one of the peaks or the troughs that need to be in the oversold or overbought zone for that divergence to be relative. We don't really want to see divergence in the middle, right? Like we don't want to be seeing both divergence peaks in the middle of the oscillator in between, say, the 40 and the 60, because it doesn't really give you as much relevance. It's not really painting the story of an overbought or an oversold market. So what you want is one of the peaks or troughs to be in the oversold or overbought, at least one of them, and that makes that valid in our mind. That's our rule set.
So here's an example we took recently. This is literally just from a week ago or so, not even probably, on the euro US dollar at the time of this recording. And you can see here we've got the euro US dollar making a lower low. So you've got a low and a lower low. It kind of looks like the one we had before on the slide. But again, what's the oscillator telling us? Well, here the stochastic is saying, hey, I'm not making a lower low at the same time the market is. So maybe the market's getting ready for a turn. And of course, it did after that. This is just on a 15-minute chart, not taking anything in particular, just something we're looking at. Then you can see over here, you've got class A again. You've got a lower high on the indicator and a higher high on the price chart. And of course, we do get that fairly decent little reaction to it where the market drops off about 25 points, 30 points in terms of market moves. So can these be used in conjunction with other techniques? The simple answer is absolutely they can. One of my favorite ways of doing it, we'll just go back to that previous slide, is to understand that when we have, let's say, a market change of trend, let's say we have a low over here. Whoops, we'll just go back here for a second and we'll load this up. We've got a low here, and we've got a lower low, and we breach through this high. In essence, at this point, we can put some things together. We often say patience, react, don't predict, Ty. And what that means is that we can look at the weight of evidence at this time and say, well, what's happened? What if this was a key level of demand on the higher timeframes? What if this was a support on the higher timeframes? We see a reaction that gives us class A bullish divergence. Then we get the breakout of the higher high, the change of trend, and it's all happening at a higher time frame key zone. Could that be very good for us as a day trader or a scalper? The answer is quite simply yes, it could. And we could potentially profit from that move into the next level of resistance, and something that we could look for during that session. So it's actually very handy as well, right around London Opens in particular, isn't it? When you get those kind of traps, which often push in one direction and then reverse. Something that I'm sure many people in the comments down below will mention. Yes, I've been trapped by the London trade before, because it does tend to get us.
It's a rite of passage, I think. It's a rite of passage. You don't get caught out in London. You haven't really traded enough yet.
You haven't traded enough, especially enough currency yet, that's for sure. What other indicators do we like to use with stochastic divergence, Ty? There are so many of them, but these are just some I've put down. Do you have any others that you would say, you know what, I really like that as well? We've got RSI, MACD, support resistance, and levels of supply and demand zones. I think all of those can be built together with Confluence. Are there any others that you like as well?
I think I'd like to throw Bollinger Bands in there as well, because Bollinger Bands give us a volatility indicator of what's actually happening volatility-wise. What I love about combining the MACD, the RSI, the Bollinger Bands with support and resistance and stochastics is each of those indicators is giving us a completely different reason why or why not to do something. One's momentum, one's volatility. Don't be confused. Volatility and momentum are two totally different things in the market. So Bollinger Bands, whatever they're telling you, are completely different to what the stochastics is telling you. So what people often do is they get caught in the trap of actually having 5 or 6 indicators on their chart and saying, I've got 5 reasons to sell something. And they're all momentum indicators, or they're all volatility indicators. So you're basically telling yourself what one indicator could have already told you. So you want to be making sure that when you're using indicators and teaming them up together, that they're telling you a different aspect of what the market's actually doing. So when you do get that confluence and you get everything agreeing with each other, you're doing it for separate reasons. Okay, so stochastics is giving us momentum. If Bollinger Bands agrees, you got volatility on your side as well. They are two separate things and two very, very important things to combine. Add to that, Fibonacci's and support and resistance, and you're going to have a really, really good picture of what you're trying to achieve. So I think probably one of the most important things is to really understand. I think when it comes to stochastics and any indicator, understand the market that you're in. I don't think we can say that enough times, Tom. Understanding whether you're in a sideways market or a trending up or a trending down market is pivotal to using the correct indicator to actually give you a result that you're really hoping to achieve.
Yeah, it's all about understanding so many more things than just the basics as well, Ty. I think that, we can say, such a simple indicator, but at the same time, how do we build it and make it a little bit better?
It's only simple if you understand it. And it's only simple if you know which market to apply it to.
They say keep it. They say keep it simple, smart. Yes, keep it simple, smart. That's the new version.
Simple, smart.
All right, so that brings us to the end of the theory for today, but that's not just the end of course, this chat. So you have put in some great questions. I'm going to read a few of these out, and of course, we're going to get into some charts as well, Ty, as we like to do. So first up, let's do. Oh, get rid of myself there in terms of the reverberation. Now we've got a couple of questions, and the first one was from. Well, firstly, I'll give a shout out to a few people that are joining us because we've got quite a few people joining us here in the chat. Let's do this. Oops. All right. So shout out here to Michelle, Paul. I'm not sure if I'm going to mispronounce. I think it's Abhijet, hopefully. The Temperate Trader, Locke, Keywood. And then we've got Smart Money TV, Irinder, Chad, and many others, Adam, etc. Journey.
Welcome,
so many people.
Stefan. We see you there.
Now, Sufian says, learn some of the best lessons from this channel. That's awesome. Great to hear. Thank you so much for being a subscriber, and hopefully you enjoyed the content. And it says here, I would love for you guys to dig into how trade significant volume during these periods as how the professionals do it. So I guess this person, the Temperate Trader, is talking about probably something to do with level 1, level 2 data, that type of thing. Well, it depends what type of market you're trading as well. So does volume matter? Absolutely. Do I think something like the volume profile indicator is an incredible tool? I would highly suggest you consider that, especially for currency. You will find it very, very difficult, though, to get volumes the same way maybe a large high-end trader would from the currency market, wouldn't you, Ty? Because it's not really necessarily fully regulated in terms of when we get all of the liquidity feeds going through an exchange. Instead, we have a hell of a lot of liquidity feeds all going through our platform here at Pepperstone. So we have a ton of liquidity, but you might not have every single piece of volume in the world, would you? For a currency.
No, that's right. No, so yeah, it's best to stick with the biggest and the best. And this is why, this volume, if any volume is going to be useful, it's going to be the Pepperstone volume because they get so much liquidity through there. And it's not just the Pepperstone trading, it's from everywhere. So yeah, you have to go. It's no point tricking yourself, right? I mean, if you're going to go and look at a broker that's only using their volume as the volume guide, you're getting a very distorted view of what's actually really happening. So it's like anything, the more information you have, Tom, the more important it's going to be. So, and that actually, that does lead us into another question that I'll just take. I think Adam, was that Adam's question? Might have been, but he said the 15-minute is the lowest. You should take divergences seriously? ? Or will lower time frames like 5 minutes also have accurate divergences? That it's a good question. And look,
good question.
It is a good question. 15-minute, 5-minute is absolute scalping, right? Like you're absolutely scalping the markets really sharp and hard when you're looking at divergences on the 5 minutes. It goes to our general rule that the bigger the time frame, the more important the signal. Okay, so a divergence on a 15-minute is important in the context of that chart and what you're trying to get it to achieve, but nowhere near as important as divergence on a 1 hour or a 4 hour or even more so on a daily. The bigger the time frame, the more important the signal. I tend to not look at divergence under 15 minutes. In fact, 1 hour is probably as small as I go for divergence, to be honest, because that's just simply the type of trader that I am. But if you are a session trader that you're getting in there and you're trading 3 or 4 solid hours of a London session or a US session or something like that, the 5-minute and the 15-minute can be beneficial. But only in the context of what you're trying to achieve from that trade. So don't be fooled into thinking that divergence is going to start up a 200-point move on a 15-minute chart because it's there. Because quite often all it's doing is single. Sometimes it does, because I mean a big move does start from somewhere, but that's not going to be consistent. So you really want to keep your, I guess, what you're trying to achieve in check, and then you can use divergence on any time frame, except the tick chart. I wouldn't think that would work very well on the tick chart.
I do think, though, that even in this example here, where I'm just looking at, I just had a look at the 5-minute there on the euro, and this is obviously where I took it for the slide here, is just so you can see how recent some of this action was. And the reason why I actually think that just in my answer, I'd probably go with the 15 minutes seems to be pretty damn good and pretty clean in comparison to the 5 that we just saw there, Ty. I feel like that 5 was scary for me.
5 minutes is scary. 5 minutes is scary stuff.
I didn't see the divergence love. So sometimes I would probably say setting it up on a 15 might be good, but of course you can use it everything except for maybe a tick
And
chart for sure.
15 minute will be getting you scalps too. Don't worry about that. Like you'll get
Mhm.
scalping opportunities in a 15-minute chart, quite simply because it's the amount of candles that it takes to actually form the formation. Like that's what you've got to look at. So a 15-minute chart might require 20 or 30 candles to actually make a formation that's going to give you divergence, and that's
Mhm.
going to give you the best part of a trading day or half a trading day or a whole session. Whereas a 5-minute one might only give you about 2 hours worth of action. And that could be when the bankers go to lunch. So you're getting a false reading in the sense that you're really getting distorted information because the representation of what's making up that signal is a very, very short time period. That's what 5 minutes does. But 15 minutes is a bit different because obviously every 4 15-minute candles is an hour. And if you're trading a signal that's being based on maybe 8 or 9 hours worth of market action, that's going to give you far better results than something that's only based on a couple of hours.
Here, I thought we'd just do a quick breakdown of a higher time frame, Ty. So, just because the euro is an interesting point. So, there's obviously a few things here on this chart. Let me just quickly remove some of these giant arrows for things. But basically, what we're seeing here is we've got the euro at a very interesting point. You can kind of notice that before there were some buyers at this level. We're kind of at these points where we've got dojis that we've talked about a lot, and you can also see that there have been some candles both ways, both a bullish hammer on the weekly here to the upside, and of course this bearish looking candle. And if you compare this to something like the dollar index, it tells you that we're at a very pivotal point. We're at a zone where there is kind of like a very big struggle between the bulls and the bears. And remember, we were talking about the 1122. So this is kind of like one of those markets where it's not perfect on both sides. Nothing ever is. Theory versus reality can be sometimes a little bit different. But we're basically in some form of either accumulation or distribution. Now, remember, Wyckoff claimed that we would hit these types of points when we would be building a position, either for a larger move to the downside or for, of course, a move to the upside. And we're trying to find that. But this is one of those situations where you can kind of say, well, if I was in let's say, an entry point towards the long side, I could see a lot of people trying to take profits around this level, Ty. And I could also see people trying to take profits on the bottom end in this case, because where we are right now is kind of like 3/4 to the way up. And if we are finding trades, let's say it comes back to this level and then you see some stochastic divergence at this level, it's class A, it's looking pretty strong. You've kind of got that market that's gone, super high and then down, and then you're getting this kind of action at the same time, the high and the higher high. Well, that's the type of thing we want to bring together, isn't it, when we're building a confluence story on these charts?
Absolutely. Absolutely. And do you see why, hopefully it's coming across as why it's so important to understand what the indicator is actually trying to tell you when you actually apply it to the market? Because when you know what the indicator is effectively trying to tell you, it makes it far more easier to apply it to the price action that you're actually seeing. So, there's a lot of things. I can give you 3 or 4 reasons why, this looks strong from this point onwards and why people would be taking it up to the 106. And stochastics is only one of them. And I think that's why it's so important to understand it. Don't worry about the moving average lift off. Don't worry about the price change in higher high, higher low sequences and the divergence. It's got a lot of reasons, and I think that it's really, really important to bring them all together. And that actually answers Chad's question at the same time. Does our courses does it show you how to do these trades? Yes, it does, Chad. In fact, there's a chapter on each indicator because they are also important. So. And then it brings it all together. Because I think bringing the indicators together, one indicator alone, we find doesn't do the job, does it, Tom? It's really a combination of indicators in the right markets. And when you have that in your toolbox and you understand which tool is needed for which job, because it really is just like that, it is really, really easy to understand. And the course certainly does go through all that and shows you how to apply it properly.
Yeah, it's all about applying it to the chart in an effective way with confluence so that you can kind of eliminate as many bad trades. A lot of trading is not necessarily the number of times you do trade, it's the quality of the type of trading that you're placing. And of course, a lot of it is also down to human psychology. If you think about it, if we're risking, let's say, $100 and we're only making $50, it's going to be very difficult for us to be successful long term. Whereas if we're risking $100 and we're kind of gaining, $200 or $300 or $400, that what we call 3 or 4 to 1 trade, then it's a little bit better. And that usually comes with being patient. And as we say, patience, react, don't predict. So a lot of our courses, such as our day trading, masterclass or any of the things that we've got on our website, they are all built around building a confluence story and therefore being able to create a replicable strategy, whether it be for currency, whether it be for indices or any of those types of things.
Exactly.
And Stochastic is something we use quite a lot in some of those courses for sure.
Yeah, in the day trading masterclass in particular, Chad, there's a live session every Monday that actually goes and looks at the live charts and how to apply it, how to apply the techniques in that. So we try, and also our live streams that we do, like we seem to do like 100 a week of them anyway. So
I'm doing one very soon, actually.
We certainly do apply them. So.
It's always happening. All right. Yeah. Well, I think we'll answer this kind of last one here, Ty, which is from the Temperate Trader. In terms of my trading, the only consistency I'm seeing is my consistent failure. Well, that's not good to hear.
Not good to hear.
So thanks for the info. No, it's not good to hear, but a lot
you can
of
turn
that
around.
Has to do with you can turn it around, and a lot of it will actually be mistakes that you're making through not having necessarily the confidence in something that you might even have a replicatable system. You don't know it yet. Generally, risk is one of the biggest issues. Over risking is a big problem. We try to, especially as guys, let's say that's one thing I found, that people try to run the sprint, Ty, and it's more of a marathon. A good little rule of thumb is that there is a lot of psychology that goes into replication. In general, it seems to be proven that if you've taken the same trade around 40 times, you generally will therefore have a replicatable system that you will actually feel confident in all market environments. Most of us stop around 12 to 13. So I ask this to the chat right now. Have you had a system where you started it, you felt good because it won a few times, you've taken a loss or two, maybe 3, and then you've quit before 12 or 13 of the same system, and you generally start to quit around that period? If the answer is yes, then put your hands up right now and put it in the chat. I will say I've done that many, many times. The key was to really keep it simple, smart, and more importantly, to think about your strategy from a perspective of, does it actually make logical sense? And if it made logical sense, you'll find that you have a lot more confidence in it as well.
Yep. 2 rapid answers to a couple of the questions that I saw earlier. We use the standard settings for the Stochastic, standard platform settings. We'd never change it. So whatever your platform gives you is generally the one we want to just use. We don't change any of the settings. Okay. So whether it's MT5 or TradingView, we always go with the default settings of the Stochastic. We don't want to be recreating the wheel there. And the question was, just in case you might have missed some of this earlier on, it is absolutely a sideways moving market indicator. You can use it in a trend, but I highly suggest you watch the entire video and webinar to understand how to do that if you missed that part. But it is primarily and best used in a sideways moving market. For that answer.
Yeah. Final one here, Ty, very quick. Chad says, do you guys use news to make trades? I've usually stuck to stock because of the flood of news from both economies. Okay, so I guess the simple answer is you can use news, but actually you want to generally use news as a trap. That would be the best way to replicate strategies. It's often the reaction to the news that will then push in a certain direction. Have you ever asked yourself the question, why does it go one direction and then 2 hours later it's off in the other direction? A lot of that is actually a replicatable strategy. So you can always watch some of our other videos we've got over here on Pepperstone's YouTube channel. If you enjoy this stuff, make sure to give it a big thumbs up. But look, when it comes to trading, it's all about replication, guys. Do consider, if you're having struggles, if you're feeling like, everything's pinned to you, I bet you if you down your risk a little bit, you'll find that things start to get a little bit easier. And remember, it is a marathon, not a sprint. From all of us here at Pepperstone, thank you so much for watching. We'll see you next week, same time, same place. So make sure to set the alerts here for the Pepperstone channel. Watch those live events. And if you're in the comments section down below, we see you. Thank you very much for supporting us. And we'll catch you in a week's time. Tyrone, anything else to say to everybody? We always appreciate everyone.
We appreciate you and thank you so much for giving us your time this evening and this morning, depending on where you are in the world. And we look forward to seeing you next week.
Okay. All right. Thank you very much. Bye for now.